Anurag Jain of Canara, HSBC, OBC Life Insurance. Anurag, hi. Thank you so much for patiently waiting by. Let's begin by talking about your sense that you're getting on the markets, because if you look at a longer period of time, the FII trend has not been very encouraging. But for the last couple of weeks, the trend seems to be reversing, and we're looking at FIIs buying a fair bit into the Indian equity markets. Can we see that trend sustain going forward? What's the sense you're getting from your HNI clients who are based here and abroad? What is the kind of view they hold on the Indian markets right ahead of a critical time as elections?
Sure. Thank you so much for having me on the show. I want to put across 4 points here. Number one is that Indian markets have significantly underperformed its regional peers and global peers over the last couple of months. China is up 20% since January. Indian markets are down almost, not down, but they've relatively underperformed by almost 13% over the period, which makes us relatively quite attractive versus the other peer markets. Secondly, the macros remain really stable. They are very favorable. If you look at oil prices, commodity prices, currency, they are at reasonable levels, neither too high, neither too low. Inflation is under control. We are expecting more rate cuts going forward. Also, over the last 2 weeks, the probability of having a stable political environment has significantly improved. So all these factors put together have significantly enhanced the attractiveness of the Indian market. Also, if we look at the positioning of FIIs in domestic markets in India, they have one of the highest underweights in the Indian market today, which was created over the last year or so. The reasons for being underweight on Indian markets is diminishing, and hence in order to not to underperform relatively, we may see actually that FIIs may continue to buy. The trend that we've seen over the last week or so, that may actually continue, and FIIs may actually continue to buy till they at least get to a neutral position. So from a near-term perspective, we remain quite constructive on the market and the FII flows as well.
To hear, Anurag, broader markets seem to be the biggest talking point for the last couple of days. Talk to us about what's your view. Is the worst phase over? Because they have consolidated quite significantly over the last 1 year. So do you think it's a good time to buy into some of these small and mid-cap names?
Sure. So we as a house remain quite constructive on the broad market. Over the last year or so, we have seen significant correction in broader markets and stocks and sectors there. Over the last year or so, the rally in the market or Nifty or even the mid cap and small cap indices have been very, very narrow. So maybe 10-15% of the stocks have really driven the market or kept them where they are, while rest of the pack has significantly underperformed. So we are actually seeing significant value coming in there. So the idea would be to back good companies, good managements, good businesses, where even valuations have started to look very interesting now. So from broader market perspective, we remain quite constructive, and we believe that exposures taken today or currently in the broader market can lead to significant value creation over the next couple of years.
Another sector that you're betting on is corporate lenders. Do they belong primarily from the private sector, or the public sector banks as well is something that you're looking at this point of time? And what are the levers you're identifying that could probably propel growth from the current levels?
Surely. So we are extremely positive on corporate lenders, mainly private sector lenders, but some of the very large PSU names also fit the bill. The whole idea here is that a confluence of factors are working. So they are now in a virtuous cycle and may continue to be there for a couple of years. So for example, we've seen clearly that NPA cycle has peaked. We are seeing recoveries happen at an increasingly accelerated pace. Provisioning at some point in time would start to come off. So balance sheet quality is improving. The net earning funds of the banks is increasing. So that means there would be bump up in margins. Also, there's been a significant increase in pricing power post the NBFC crisis for these banks, and hence in terms of earnings growth, we would see a significant traction in earnings over the next couple of years going forward, and valuations remain reasonable. These sectors and stocks have significantly underperformed for last couple of years, 2-3 years, 4 years. So similarly, the virtuous cycle will also play out for the next couple of years. So we remain quite constructive there as well.
Okay, great chatting with you, Anurag. Thanks so much for coming on board and sharing with us your market perspective.